Yeah. So that was related to the nominal GDP. Now coming for the real GDP, it is nothing but the base year price into the current year quantity. So what is a base year? Okay, so base year is nothing but it's a comparison which is being used to measure in a business activity or an economic index. So when I want to compare, we can go and take this base years. Okay, so base years have been decided for every 4 or 5 years, or sometimes it crosses more also. Right now in India, if you see, the ministry is considering the base year to be 2011 and 12. Okay, so there is they want to change it, the new base year to be 2017 and 18. Okay, yes, so base year is nothing but the prices which are being prevailed in that particular year, they are going to take that for the calculation of the real GDP. Okay, so if you see in 2010, price into quantity is 10 into 10. Okay, so if we are considering 2010 to be the base year, okay, so what will be the base price? That will be 10. So for all the years, we take the prices to be 10 only. Okay, so 10 into 10, 100, 10 into 12 is 120, 10 into 25 is 250. So this is the real GDP. Okay, now we have one more concept. Why the screen is not moving? 1 second. Yeah. So coming for this, what we call it is as a GDP deflator. Okay, see, when we have seen the first GDP, I said that there is an increase of 35%. That increase of 35% is because of an inflation which has happened. So really, the inflation, the increase of GDP, is it because of a price or is it because of a quantity? When we want to find out, we can go for this. So in real GDP, what are we saying? In real GDP, we are making the price to be fixed. Okay, and we are changing the quantity. In nominal GDP, what are we doing? We are changing the price as well as we are changing the quantity. Okay, so price into quantity is the real GDP or the nominal GDP calculation. So if you are going to calculate this GDP deflator, the formula is 100 into nominal GDP by the real GDP. Okay, so if you are going to substitute this, so nominal GDP is how much? 625. So 625 divided by real GDP is how much? 250 into 100. So again, once again I am repeating, GDP deflator will be equal to what? 620 divided by 250 into 100. So what are you going to get if you substitute and get, and the answer will be 250%. So nominal value is 150% more than the real GDP value. Okay, and this increase is because of what? The increase is because of the prices which has happened, which has been increased. Okay, yes, so this is related to the GDP deflator. Now coming for the remaining things like an NP and DPs and all those things. So gross domestic product is also called as the gross domestic income. Okay, yes, so now listen carefully. Whenever you have a doubt, pause the video, go back and listen. Okay, so there are important concepts also. What is GDP? GDP is nothing but gross domestic product. What is market price? The MP is nothing but the market price. What is market price? I already explained you, saying that it is the price which is being paid by the consumers. So GDP at a market price, if you are going to take, and from that you are going to remove the depreciation. Okay, then what is depreciation? Depreciation is nothing but reduction in the value of the asset. Why are we considering this? Okay, see this more or less what are we saying? It is the income what you are going to get by selling the, or by producing, basically I am not supposed to use selling, by producing the products, right? Okay, so when you are producing the products, you use certain assets. What are assets? Land, buildings, machinery, furniture and everything. Okay, so the value of that particular machinery or land and everything is going to come down. So it is not an income. Okay, so you are supposed to remove that particular reduction in the value of the asset. What is depreciation? So from GDP, which is of a market value, you are going to remove the depreciation. Yes, you are going, the net result whatever you are going to get is net domestic product. Okay, now whatever we have calculated, this net domestic product is on what? It is on the market price. Okay, yes, now from net domestic product market price, you can add or you can deduct the net factor income from abroad. The short form for this is what? NFIA. Okay, NFIA. What is the formula you are going to have? NFIA is nothing but equal to factor income from abroad minus factor income to abroad. Okay, what do you mean by this? See, simple example. Take for example, your father is working in an IT company. You are staying in Hyderabad, right? Okay, so he got a chance and he has gone to abroad, US or UK, whichever country, even Pakistan also they go. It's not an issue. Okay, they go to another country. Okay, and they are going to get the income over there. Okay, so what we do is we get that income which is being earned by that person from abroad. Okay, now in the same way you have a factor in the people who are working from other countries in India. Okay, so that income we are going to send it to abroad. Okay, so basically what are we going to do under this is we are going to consider the income what the people are going to get of the nation, and we are going to deduct the other countries people or companies incomes and everything. Okay, so if this is more, what we are going to get is more than what we are going to give. Okay, then we get the symbol plus. If we are getting less from abroad but we are giving more, then it is minus. So that's the reason I used both the signs, plus and minus. Yes, ma. So I think the concept is clear. This is, and our people are going to other countries and earning that income we are going to take into consideration. Here, whatever people are coming from other countries and they are going to earn, it might not only the people, the firms also which are going to another example I have taken about the prince. So people, right? So take for example Infosys or TCS. Your brand TCS is there. TCS is having an office in US. So that income, whatever they are going to get over there, the profits or otherwise all the things, we get it to India. IBM is there. IBM is not from India. Yes, so that income, whatever, it will be going to that respective country. I think now it might be clear. Yes, ma'am. So if what we are getting is more than what we are giving, then it is plus. What we are giving is more, sending to abroad is more and getting from abroad is less, then it is minus. So from NDP, net domestic product of market price, plus or minus of NFIA. What is the thing what you are going to get is net national product. Clear till here? Now, net national product of market price. You are going to deduct the net indirect taxes. Okay, what are net indirect taxes? Short form for it is NIT. So NIT is nothing but equal to indirect tax which is being paid minus the subsidiary. Okay, yes ma'am. Okay, so basically when you take this into consideration, okay, yes, so you have a market price. Yes, what are we saying market price? Market price is nothing but what we are going to charge a customer when we are selling. So government, it takes the taxes from us. Okay, so what is the tax which is being paid? That is the GST. GST is the indirect tax what will be paid, okay, by the companies. Okay, yes, so take for example the indirect tax through GSTs and everything they are going to pay somewhere around 200. Okay, now the companies get a subsidiary on that. Yes, on the indirect taxes whatever they are paying and everything, they give a certain subsidy. What is the subsidy? Like if they are going to start a organization where the government wants them to establish, they get a subsidiary. Okay, yes, or take for example tax holidays are being given, tax waivers are being given, so certain subsidiaries are being given. Yes, we call them as the transfer payments. Okay, yes, so it can be certain benefits which are being given. Yes, so if you are going to deduct that from the indirect taxes paid, GSTs and everything, you are going to remove this subsidy which is being given. You are going to get what? NNP at a factor cost. Okay, yes, okay, yes. So now NNP as a factor cost is the national income. Yes, so like NNP is also called, NNP as a factor cost is also called as a national income. So when national income is divided by the total population of that respective country, we get the per capita income. Yes, ma? Okay, now what is personal income? The other one. Personal income is nothing but the income which is being received by the households without paying any taxes and everything. So the gross salaries are taken into gross salary, or the interest whatever they receive. The overall the amounts whatever they are going to receive is the personal income. Disposable personal incomes are what? From that personal income, if you are going to deduct the taxes, yes, okay, so whatever is being left out, we call that to be the disposable personal income. Okay, yes, so this disposable personal income is nothing but equal to C plus S. What is this C? C is nothing but the consumption. So whatever a consumer has or a person has, for what purposes he use it? Either he is going to use that particular income to consume goods and services, or otherwise he is going to put it under a saving. Saving is nothing but he is going to make an investment. He can put it in a bank, or he can put it in mutual funds, or all those things, and he is going to save. So disposable personal income is equal to C plus S. So these are related to the different concepts of the national income. Okay. Yes, now coming for the next one, we are going to talk about the properties or technical attributes of consumption function. Yes, ma. So consumption function, basically, see, that's what I have said. Formula just now, what did we see? The disposable income, whatever the persons or people have, we are going to consume it for the commodities. Yes, okay. So how that is the consumption related. So income is also equal to consumption plus savings. So Keynes or Cans, whatever pronunciation you want to do it in American accent or British accent. So he has taken the consumption function, and next we are going to do the saving function also. Yes. So for this, he used one thing what we call it as propensity to consume. Okay. So what is it? The part of income what you are going to consume. Yes, is PC. Okay, yes. So basically whatever we get the income, completely we are not going to use it, or we are not going to buy the goods and services. We are going to save also. Okay, so what is propensity to consume? It is nothing but the part of income which we are ready to spend, or which we are going to purchase the goods and services. So propensity of to consume is of two. One we call it to be the average propensity to consume. The other one we call it to be the marginal propensity to consume. Average propensity to consume, how are we going to calculate is consumption divided by income. Okay. Yes, marginal propensity to consume, how are you going to calculate is delta C by delta Y.